Welcome back to the deep dive. Today, we're going to a dark place, a really dark place.
We are.
We aren't looking at the shiny upside of the market. We're not talking about, going to the moon or how rich we're all going to be when the dollar finally collapses.
No moonshots today.
No. Today, we are talking about the nightmare, this specific cold sweat scenario that I know because I've read your emails, and honestly, because I felt it myself. It keeps every single stacker awake at night.
It's the scenario that nobody really wants to discuss out loud, but everyone thinks about it when they're looking at that heavy safe in the basement.
Exactly. It's what I call the desire loop. You spend years, maybe decades, building a stack. You buy the monster boxes, you get tubes of Eagles, the 100-ounce bars. You do it for one core reason: insurance.
Right. It's an insurance policy.
It is. You don't trust the banks. You certainly don't trust the Federal Reserve. And you view that metal as your final, absolute line of defense against a financial system that just feels, well, it feels like a house of cards.
Mm-hmm.
But here's the paradox. This is the part that gets you. To get that safety you crave, you have to bet against the very system that provides all of your daily liquidity. And that creates a very specific gnawing anxiety.
It creates what we're calling the zero hypothesis.
Zero hypothesis, yes. Let's paint the picture because we need to be visceral here. We have to really feel this.
Okay.
Imagine it's a Tuesday. The news is just screaming. The stock market isn't just correcting, it's crashing.
Yeah.
We are talking 1929 style, Black Tuesday.
Circuit breakers are tripping left and right.
Total panic in the streets. People are liquidating everything. Gold, bonds, stocks, everything. You pull out your phone, you open your app, and you're expecting to see silver skyrocketing because it's a safe haven. I mean, that's what all the gurus told you for years.
But that's not what you see on the screen.
No, not at all. You see red. You see the spot price just plummeting. It's not $30. It's not $20. It's crashing toward 10. It looks like it's crashing toward zero.
And the panic starts to set in.
Oh, it's a gut punch. So you grab your bag of silver, you jump in the car, you drive to the local coin shop because you need cash now, maybe to buy food, maybe to pay the mortgage, whatever. And you get there, you pull on the handle, and the door is locked.
The open sign is flipped to closed.
Flipped to close. And you're just stuck there on the pavement with a heavy bag of metal that you technically own, but you can't use. You're a bag holder in the middle of the apocalypse.
That is the ultimate fear, isn't it?
Right.
Illiquidity. The idea that when the price crashes, the market for your asset, it just evaporates. It's gone.
It's gone.
It's the fear that you have bought this incredibly expensive insurance policy that refuses to pay out exactly when your house is burning down around you.
And that is where we're going to live today. We are going to stare that fear directly in the face. Is it true? I mean, really, is it if the spot price hits zero, does your stack of silver suddenly become a $5,000 paperweight?
Or is there something else going on under the hood of the market, something purely mechanical that most people are missing?
Because if I'm holding my wealth, my family's wealth, in physical metal, I need to know, absolutely need to know, if I can actually spend it when the chips are down.
It is a completely valid fear, and I appreciate that we're tackling it head on. But I am here to tell you that this fear, it's based on a fundamental, and I mean fundamental, misunderstanding of market mechanics.
Okay.
If we look at the data, and we have a lot of it here, we're going to look at the 2008 crash, the 2020 liquidity crisis. The story the data tells is actually the complete opposite of that nightmare scenario.
The opposite. Hang on. You're telling me that if the price crashes, it's somehow easier or better for me as a seller? That sounds like wishful thinking. That sounds like hopium.
I know, it sounds completely counterintuitive, but I'm not saying it's better emotionally. I'm saying that when the paper price dies, the real price doesn't just survive, it decouples.
Decoupling. Okay, that is the magic word for this entire deep dive, isn't it?
It is the central thesis. My role today is to be the calm voice of reason here. You know me. I'm not a gold bug. I'm not a cheerleader for any asset. I just look at the math.
Right.
And the math strongly suggests that the fear of the closed coin shop is, for the most part, a myth. We need to explain exactly why the dealer's door won't be locked and why a crash in the stock market might actually be the most profitable moment for a physical holder, provided they don't panic.
Okay, let's get into the machinery then. I'm ready. To understand why that door stays open, we have to understand what we're actually looking at when we check the price of silver. Because I think this is where all the confusion starts.
It's the source of almost all of it.
We see one price on Bloomberg or CNBC or Kitco, whatever. Silver is $22.50. It looks official, it looks final, But that's not the whole story, is it?
No, not even close. And this is
Ugh.
what we call the two markets concept.
Hmm.
It is absolutely crucial to get this right. We tend to talk about the silver market as if it's, one big room where everyone, miners, banks, stackers, jewelers, all trades together.
But it isn't.
It isn't. It's two completely different rooms with different rules, different players, and different products that are just masquerading as a single entity.
Okay, lay it out for us. What is room number one?
Room number one is the paper market. This is the COMEX. This is futures contracts, it's derivatives, it's ETFs like SLV. When you see that ticker symbol flashing across the bottom of your TV screen or you check a finance app on your phone, that is the paper market talking to you.
And who is in that room? Because it's certainly not me, and it's not the guy down the street with a safe full of constitutional silver.
No. The players in room one are high-frequency trading algorithms, massive hedge funds, bullion banks like JP Morgan, and big industrial miners who are hedging their future production. They're trading contracts.
And these aren't small contracts?
Not at all. A standard COMEX silver contract is for 5,000 troy ounces.
Whoa, hold on. 5,000 ounces. I'm doing the math in my head. That's over 300 pounds of metal.
Roughly, yes.
Yeah.
It's a huge amount. Now, you have to ask yourself, when a hedge fund manager in Manhattan trades that contract, or an algorithm executes a high-speed trade in a nanosecond, does anyone actually want 300 pounds of silver bars delivered to the lobby of a skyscraper?
Definitely not.
Yeah.
I mean, they'd have to reinforce the floors. It's ridiculous.
Exactly. It's a betting slip. That's all it is. It's a financial instrument designed purely to speculate on price direction or to hedge risk. The vast majority of these trades, and we're talking over 99%, are settled in cash. They never, ever touch the metal.
So they're not trading silver.
They're just trading the idea of silver. It's digital leverage.
So room one is basically a giant casino. It's digital ones and zeros. It's people betting on the price of something they never, ever intend to own.
Precisely. It is a derivative market. The value is derived from the underlying asset, but it is not the asset itself.
Okay, that makes sense. It's infuriating, but it makes sense. Now, what is room two?
Room two is the physical market. This is the street. This is the coin in your hand, the American silver eagle, the Canadian maple leaf, the 100-ounce bar you have in your safe, even your sterling silverware. This market is driven entirely by physical delivery.
If you buy it, you take it.
You take it. If you sell it, you have to hand it over. It is constrained by actual physics, by logistics, by mining output. You can't just create 1 million ounces of it with a keystroke.
And here is the disconnect that drives me, and I think a lot of people, absolutely crazy. I'm holding a physical object. It has weight. It has industrial utility. It has thousands of years of monetary history. But the value of this object, the price I'm told it's worth, is being dictated by the guys in the casino room who are just betting with paper. Why? Why does a paper price dictate the physical price?
Well, in normal times, a process called arbitrage keeps them connected. It's like a rubber band. If the paper price drops too low relative to the physical, big players can buy the cheap paper, demand delivery of the metal, and then sell that metal into the more expensive physical market for risk-free profit.
And that buying pressure brings the prices back in line.
Exactly. It pulls them back together. But, and this is the entire point of the decoupling we're talking about, when the system comes under extreme stress, that connection breaks. The rubber band snaps.
I want to use the analogy from the research because I think it's just the best way to visualize this for anyone listening right now. The notes call it the thermometer versus the weather.
Yes. This is mandatory, required understanding for anyone who holds real assets. Think of the spot price, that number on the screen from the casino room, as a thermometer. Its only job is to report the temperature.
And the temperature is just the balance of supply and demand. Simple enough.
Right. Now, the weather. The weather is the physical reality on the ground. How much metal is actually available? How many people want to buy it right now? Is there a shortage? Are the mines shut down because of a pandemic? That's the weather.
Okay, so the thermometer measures the weather.
It's supposed to. But in the silver market, the argument, a very strong one, is that the thermometer is effectively broken.
Broken how? Just inaccurate. Like it's off by a few degrees.
Worse than inaccurate, it's being actively manipulated or, let's say, distorted by billions upon billions of ounces of paper derivatives, those betting slips we talked about, that don't actually exist in the physical world.
Billions.
There is far more paper silver traded in a single day on the COMEX than is mined in an entire year globally. It's not even close.
That is just staggering. So the paper market, the casino, is flooding the thermometer with fake data. It's giving it inputs that don't reflect the real world at all.
Exactly. So let's run the simulation. Imagine this scenario right now. It's the middle of July. You are standing in the middle of the Mojave Desert. The sun is just beating down. You're sweating through your shirt.
Awful. Okay, I'm miserable. I'm sweating.
The physical reality, the weather is hot. High demand for water, physical scarcity of shade, just burning heat.
Got it.
But you look at the big digital thermometer on the wall of a nearby building, and because of a glitch in the system, because someone messed with the wiring, it reads -50 degrees.
-50. It says I should be freezing to death.
Right. It says you are in the middle of a polar vortex,
Hmm.
a blizzard. Now, here's the critical question. Do you start shivering? Do you run and put on a parka? Do you freeze to death because the instrument says you should?
No, of course not. I'm hot. I trust my skin. I trust the reality of the sun burning my face. The thermometer is obviously broken.
Precisely. You trust the reality, not the instrument. And that is exactly what happens during a market crash. The spot price, the thermometer might crash to $10 because of massive paper sell-offs on Wall Street. The algorithms are dumping paper contracts to raise cash for margin calls in the stock market.
Right, they don't care about silver, they just need dollars.
They just need dollars.
Hmm.
But the real price, the weather, is what you actually have to pay to get the metal into your hand, or what someone will pay to take it from your hand.
So if the spot price on my phone says silver is worthless, but I'm holding a coin that someone standing in front of me is willing to pay me $30 for, the spot price is a lie.
It becomes irrelevant. It becomes a ghost. It's a signal that has completely lost its carrier wave. It's just noise.
I love the theory. It makes perfect logical sense. But I'm going to play devil's advocate here because I know my role. I'm the skeptical listener at home. That sounds great, expert. But does it actually happen? I mean, that sounds like a nice story. Because it feels like if the market crashes, everything just crashes together. Do we have hard proof of this decoupling, or is this just something silver bugs tell themselves to sleep better at night?
We do have proof. And it's not ancient history. We don't have to go back to the Great Depression or
Yeah.
ancient Rome to find it. We just have to look at March of 2020.
The start of the pandemic, the lockdowns.
The great liquidity crisis of 2020. I mean, think back to that 1 week in March. The world was literally shutting down. The stock market was collapsing so fast they had to use the circuit breakers to halt trading multiple times in a single week.
I remember it vividly. I was looking at my 401k and just feeling sick to my stomach. I was watching everything turn blood red.
Everyone was rushing to one thing: cash. The US dollar was the only thing that mattered in that moment.
So what happened to the paper silver market in that chaos?
It fell off a cliff.
It really did.
It didn't just fall, it imploded. The spot price hit $11.90 an ounce at one point.
Oh.
It was trading in the low teens. It looked like the absolute bottom had fallen out of the market.
So if you believe the thermometer, silver was dirt cheap. It was losing its value at a terrifying rate. It looked like a terrible investment to be holding.
Now, according to the nightmare scenario, the fear we started with, the fear that the shop locks its door, what should have happened at your local coin dealer at that moment?
Well, let's play it out. The dealer should have looked at his screen, seen $11.90, and started panicking. He should have either stopped buying completely because he thought it was going to zero, or he should have been trying to sell his inventory at $12 just to get out and cut his losses.
Right. That is what the spot price, the thermometer, dictated should happen. But that is not what happened. If you walked into a coin shop in March 2020 with $12 in your hand, could you buy an ounce of silver?
No,
Yeah.
absolutely not. I actually tried. I went online. Every major site, APX, JM Bullion, SD Bullion, they all had these big red banners at the top of their homepages. Delayed shipping, out of stock. We are currently not accepting new orders.
It was unobtainium.
The shelves were bare. You couldn't get it anywhere.
That was the decoupling in real time, in action. It was the most violent separation between the paper price and the physical price that we have seen in modern history.
So while the screen said $12,
The physical dealers were wiped out instantly. Their inventory just vanished into a vacuum of demand. And if you could find a dealer with metal, say, a secondary market Silver Eagle or a generic round that they had in the back, what were they charging for it?
it wasn't $12, I can tell you that.
Yeah.
It was $24, $25, $28. I remember seeing some cases on eBay where people were bidding $35 or $40 for a single 1-ounce coin. It was madness.
The premiums exploded. The premium, which is normally, a couple of dollars over the spot price,
Yeah.
it went to 100% or more.
100%.
The screen price became completely and utterly fake news. It was that broken thermometer reading -50 degrees while everyone outside was sweating. The street price was the only thing that mattered.
So let's flip this around to the seller's perspective, because that's the core fear we're addressing, being the seller. If I had panic sold my stack based on the spot price, just because I was scared of that crashing chart on my phone, I would have been giving away my silver for less than half of what it was actually worth on the street.
You would have been robbing yourself. You would have been the victim of the broken instrument. You would have been looking at the thermometer instead of looking out the window at the weather.
That is just, it's wild to think about. The market didn't freeze up, it just moved. The real price, the street price, completely ignored what the paper price was doing.
And that is the critical takeaway from 2020. Liquidity didn't disappear. You could still sell your silver. In fact, dealers were desperate to buy it from you. They just weren't using the spot price as their guide anymore. They were using the street price. The official price had become a complete fiction.
Okay, that leads us directly into the next big question then. The dealer's motivation. We've established that the price decouples, we have proof of it, but let's talk about the guy behind the counter. Why wouldn't a dealer just lock the door? I mean, if the stock market is crashing, the world feels like it's ending, why does he want to give me his precious cash for my metal? Isn't he scared too? Why would he want to catch a falling knife?
This requires understanding the business model of a precious metals dealer. It's very, very different from being an investor or a stacker, and most people just don't get this part.
How so? What's the difference?
Well, investors bet on price direction. You buy silver because you think it will go to $50 or $100. You are long on silver.
Right. I'm making a bet.
We're making a directional bet.
Dealers.
They don't care if silver is $50 or $5. They don't bet on the price. They are market makers. They bet on the spread.
The spread. Okay, break that down for us. What exactly is the spread?
The spread is simply the difference between their buy price, what they pay you for your coin, and their sell price, what they charge me to buy that same coin. In a normal, boring, stable market, that spread is razor thin.
Because competition is high and supply is easy to get. If dealer A charges too much of a premium, I can just walk down the street to dealer B.
Exactly right. So let's say spot is $20. A dealer might offer to buy from you at spot, so $20, and then sell to someone else at spot plus $2, so $22. They make $2 an ounce.
Doesn't sound like much.
It's not. They have to move massive volume to pay the rent, pay their staff, pay for the insurance on all that metal. It's a real grind.
It's a high-volume, low-margin business. Kind of like a grocery store.
That's a perfect analogy. But now look at what happens during a crash. During a panic event like March 2020,
Yeah.
volatility spikes through the roof. Uncertainty is everywhere.
Yeah.
The wholesalers, the big distributors, they run out of metal. And what happens to that $2 spread?
It widens.
It doesn't just widen. It explodes. It becomes the dealer's golden era.
Wait, hold on. You're telling me they make more money when the market is crashing and everyone is panicking?
Significantly more.
Hmm.
Because the decoupling creates chaos in pricing. If spot is a fake $12, but street demand is so huge that people are willing to pay $27, the dealer knows he can sell anything he gets his hands on. He isn't worried about finding a buyer. He's worried about finding product.
Okay, so run the numbers for me.
Okay, so he might offer to buy your silver at spot plus $5.
Mhm.
The screen says 12, so he pays you 17.
Which is way better for me than the $12 I see on my phone.
Right. You feel like you're getting a great deal. But then he immediately turns around and sells that same ounce for spot plus $15. He sells it for $27.
Wow. So instead of making his usual $2 an ounce, he's making $10 an ounce.
Exactly. The spread went from $2 to $10. His profit margin just quintupled. The crash is, paradoxically, a massive business opportunity for dealers. It is the most profitable time to be in the business, by far.
But there's a catch, right? There has to be a catch.
The catch is inventory. It's the only catch. You can't sell what you don't have. And in a crash, the big distributors, the U.S. Mint, the Royal Canadian Mint, the big private wholesalers, they dry up. They literally stop answering the phone because they are completely sold out.
So where does the dealer get his metal? Where does he get his inventory?
From you, from the guy walking in off the street with a tube of Eagles. You become their sole supplier. They need you more than you need them in that moment.
So they aren't going to lock the door.
They're going to roll out the red carpet. They are desperate for physical metal because they have a line of buyers, either in the store or online, waiting to pay that huge premium.
That just completely turns the whole fear on its head. We're afraid they won't buy from us, but the reality is they are desperate to buy from us because it's the only way they can feed the frenzy on the other side.
It's what I call the vacuum theory. Liquidity doesn't vanish. It just moves. In a crash, Liquidity drains out of the paper markets on Wall Street. The hedge funds sell everything to get cash. But where does that fear and that money go?
Into tangible assets.
Exactly. Main Street wakes up and says, I want something real. I want something I could hold in my hand. So liquidity moves from Wall Street to Main Street, and the coin shop is the transfer station.
So the coin shop becomes the busiest place in town.
It usually does. And as long as there's a buyer on the other side, and history shows us that in low-price environments, buyers flood in looking for a bargain, the dealer will always bid on your metal.
That is actually really reassuring. It's not about faith in the system. It's about their own profit motive. I can trust a dealer's greed a lot more than I can trust the COMEX.
Incentives are the single most reliable force in economics. The dealer isn't doing you a favor by buying your silver. He's making a killing off the volatility.
Okay, so the door is open, the dealer wants to buy. That, for me, settles the illiquidity myth. But let's pivot now to strategy. Because while this sounds great, hooray, dealers will buy, it also sounds like it's a chaotic, messy time to be a seller.
Extremely chaotic.
You mentioned earlier that the spot price becomes fake news. That sounds dangerous for a regular guy who's just trying to navigate it.
It is very dangerous. The risk in a decoupling isn't illiquidity, meaning you can't sell. The risk is price discovery.
Price discovery, that's a term economists use a lot. What does it actually mean for the guy with a stack of coins in his hand?
It means nobody knows what the real price is. When the thermometer breaks, everyone is just guessing at the temperature.
Yeah.
In a total collapse or a massive decoupling event, there is no centralized street price ticker. There's no website you can go to that tells you exactly what a silver eagle is worth in that second because the market is moving too fast and it's too fragmented.
So if I walk into one shop and then I drive to another one, I might get totally different offers for the same coin.
You might get drastically different offers. In a normal market, prices are tight. Dealer A pays you $20, dealer B pays $20.10. It's very competitive. In a crash, dealer A might be panicked, he might be low on cash, and he offers you $20.
Yeah.
Dealer B, who is 5 miles away, might have a huge waiting list of desperate buyers, and he'll offer you $30 for the exact same coin.
That's a massive gap. That's a 50% difference. If you sell to dealer A, you're losing a third of your value just because you didn't drive down the street.
Correct. And that is the premium trap. If you don't know what the real street price is, you might accidentally sell your valuable physical metal based on the broken thermometer reading. You'll sell yourself short.
So what is the playbook? Let's get tactical. If we find ourselves in this scenario, spot is crashing, the news is scary, I need cash, I need to make a move, what do we do?
We have 3 very clear actionable steps here. And step 1 is by far the hardest. Emotionally, don't panic. Sell.
Hold the line.
You have to. You have to realize that physical premiums will always lag behind a spot price crash. The physical market is slower and stickier. If you see the chart on your screen drop 10% in an hour, you must not assume that your coins just lost 10% of their value. They almost certainly did not.
So you have to completely disconnect your brain from the screen.
You have to look out the window, not at the thermometer.
Yeah.
Never, ever sell real metal for the fake paper price just because you see a scary red line on a chart. That's step 1.
Okay, what's step 2?
Step 2, shop around.
Because of that price variance you just mentioned.
Precisely. In a stable market, checking one dealer is usually fine. Everyone is within a few cents of each other. In a decoupled market, you must get at least 3 quotes. No exceptions. Call 3 local shocks. Check 2 online buyback prices. The difference could be hundreds or even thousands of dollars depending on the size of your stack.
You have to find the dealer who has the most buyers, who's the most desperate for your inventory.
Correct. You are looking for the dealer with the biggest liquidity need because he will pay the most. And that brings us to step 3. Zoom out.
Zoom out. What do you mean?
Remind yourself of the bigger picture. Look at historical examples. Look at what happened in Venezuela recently. Look at Zimbabwe. Go back and look at Weimar Germany.
What happened there with precious metals?
In a state of hyperinflation or a total currency collapse, did silver become worthless? Did gold become worthless? No. It became the currency.
It became the money.
People were literally shaving off flakes of silver from a bar to buy groceries. It became the most liquid thing in the entire country. The idea that it becomes illiquid is only true if you are trying to convert it back into a failing fiat currency within a rigged and failing banking system. But in a real, on-the-ground economy, it's the ultimate form of liquidity.
That's a really powerful reframing. We worry so much about converting our silver back to dollars, But in the absolute worst case scenario, you aren't converting it, you are using it.
Or you're converting it into a new currency or land or food or other real assets.
Yeah.
Real assets hold their value against other real assets.
Now, I want to touch on one other thing before we wrap this up, the opportunity. We've talked a lot about being a seller in this chaos, but what about being a buyer?
The great polarizer question.
Yeah, if the spot price goes to 0, or let's be more realistic, let's say it goes to $10, do you sell your stack? Or do you back up the truck and buy more?
Well, the smart money, the people who actually understand these mechanics we've been talking about, they view a paper crash as a historic buying opportunity.
Because they know the bounce back in the real price is coming.
Because they know the demand is real. It's not theoretical. If physical silver goes on sale for 50% off according to the paper market, the physical demand goes through the roof. And that tidal wave of demand is what provides the liquidity for anyone who needs to sell. So even as a seller, you are stepping into a rushing river of demand. You won't be left holding the bag.
That really drives it home for me. The fear is that you go to the store and it's empty and locked. The reality is that you go to the store and it's a mosh pit of desperate buyers.
Precisely. It's a feeding frenzy. You're selling into strength, not weakness.
So let's bring this all in for a landing. Let's get to a verdict. We started this deep dive with the nightmare, the closed sign, the broken system, the gnawing fear that our insurance policy is actually a scam.
And what we found when we looked at the mechanics and the historical data is that the fear is a myth. It is a myth designed, whether intentionally or not, to keep investors herded into paper assets, stocks, bonds, ETFs, things that are easy for the system to control, to track, and to confiscate, frankly.
But physical silver is different.
Physical silver is the liquidity of last resort. It operates outside the digital banking system. It operates on the laws of physics and scarcity, not on the laws of high-frequency trading algorithms in Chicago and New York.
So when the paper burns, the metal shines.
That's the ultimate takeaway.
I want to leave our listeners with this one final thought, and it goes right back to our analogy. It's simple, but I think it sticks. If the weatherman on TV tells you it's freezing outside, negative 50 degrees, a historic blizzard, but you are standing on your front lawn getting a sunburn, do you run inside and put on a winter coat? Or do you fire the weatherman?
You trust the weather. You trust reality over the instrument that's supposed to measure it.
Don't let a broken thermometer convince you that you're freezing. And don't let a broken paper market convince you that your real physical silver is worthless.
Well said. A perfect summary.
Now, one quick final note before we go. We've been talking about silver very generally today. But not all silver is created equal when it comes to liquidity, especially in a crisis.
No, that's a whole other layer of strategy. The form of the silver matters immensely.
Right. An American silver eagle, which is recognized globally, is going to be a lot easier to sell in a panic than some, obscure collectible hand-poured bar from a private mint that nobody recognizes.
Brand recognition is a proxy for trust. And when trust is low, which it is in a crisis, people want recognizable government-minted coins because they don't have time to assay every single bar they buy.
Exactly. And if you want to know which specific coins and bars offer the best liquidity for these kinds of scenarios, avoiding the weird collectibles and sticking to the most liquid stuff, you really need to check out our Stacker's Guide, which we've covered before and will likely cover again. It really, really matters what you buy.
Absolutely. The devil is in the details.
But for today, sleep easy. The door will be open. Thanks for diving in with us.
My pleasure. See you next time.
Catch you on the next Deep Dive.